Have you ever wondered how two people can look at the same business and come up with wildly different values? One saying it's worth $5 million, the other claiming it's worth $50 million? Who's right? And more importantly, why? Most people think business valuation and mergers and acquisitions are advanced topics meant only for investment bankers and corporate insiders. But the truth is, they were created to solve a very practical problem. When large amounts of money are on the line, guessing is dangerous. To see this clearly, imagine something simple. You're buying a house and two agents give you very different prices. You don't just pick the higher or lower number. You look at future potential, location, comparable sales, and condition. Without realizing it, you're already applying the core logic of business valuation. This is the Learning Studio, where we break down accounting and finance by connecting real-world decisions to powerful financial ideas. What's really happening in that situation is straightforward. Valuation isn't about finding a single correct number. It's about estimating what a business is worth based on assets, earnings potential, and market expectations. That's exactly what business valuation means when explained formally, translating future possibilities into today's numbers. The same idea operates at a much larger scale every day. Investors value startups before funding them. Companies determine fair prices before going public. Corporations evaluate competitors before buying them. Courts rely on valuation during disputes and taxation. Wherever ownership changes or capital moves, valuation sits at the center of the decision. That's where mergers and acquisitions come in. Sometimes two companies combine to become stronger together. Sometimes one company buys another to gain technology, market access, or scale. When Facebook acquired Instagram for $1 billion in 2012, many people thought it was absurd. Years later, that decision is seen as one of the most successful acquisitions in modern business history. On the other hand, when Microsoft acquired Nokia, the valuation failed to match reality, and billions were written off. Same process, different outcomes. This shows an important truth. Valuation and M&A are not just about formulas. They involve strategy, assumptions, timing, negotiation, and human judgment. A company isn't worth what it earned yesterday. It's worth what people believe it can earn tomorrow. These ideas weren't invented overnight or by one individual. Modern valuation and M&A practices were shaped over decades by economists, financial markets, and corporate deal-making, and later formalized through investment banking practice, capital markets, and financial theory. Over time, this turned intuition about worth into structured methods that could be compared, debated, and trusted at a global level. Once you understand this intuition, valuation stops feeling mysterious. You begin to see businesses not just as products or brands, but as streams of future cash flows, risks, and opportunities. That mindset is why valuation and M&A skills sit at the heart of investment banking, private equity, venture capital, and corporate strategy. Now that you understand the intuition behind business valuation and mergers and acquisitions, the next natural step is to explore risk analytics and cyber resilience in finance. Because in a digital world, valuing a business also means understanding the risks that could destroy it overnight. Stay curious, stay analytical, and continue the journey with the Learning Studio. I'll see you in the next episode.